welcome to another edition of the Energy Action Market Wrap. My name's John Huggart, the CEO here at Energy Action. Well, overall, the market dipped lower last week, and even though we still continue to see an outlook of rising prices, there's certainly some risk locked in now with the fear or concerns about further lockdowns or on the back of a second or even a third wave of the coronavirus, and also concerns arising from the potential permanent changes in behaviour of consumers and businesses in response to the coronavirus. Some business models may have changed permanently over the last few months, with more white-collar workers working from home. And of course, last week there was the news on the demand-side response mechanism that may have also led to a weaker price outlook, as that may be on the expectation of future lower operational demand as a result of that market mechanism. Longer dated contracts are flattening, and there's questions arising, of course, about the longer term impacts of the coronavirus, as well as the continued introduction of renewable supply into the generation mix. These factors compete with the opportunity for an economic recovery, which will have an impact on demand and potential increase in prices into the future. Over the last month, we've seen spot prices increased. That's coming from higher demand, both from the initial easing of the coronavirus restrictions, as well as some winter conditions peaking some demand. Positive sentiment and the prospect of increased maintenance shutdowns in the back end of the year have also fueled those price increases. The WA market has been relatively flat, with our index stabilising there around the 5 cents per kilowatt hour. That's before capacity charges, and we do expect gradual downward pressure in prices, and that's on the back of the recent legislation which allows standalone power systems to improve regional supply and lower operational demand. This will pave the way for more renewable-based standalone power systems and distributed storage in the state, and allow for competition to be introduced into the various private and public networks for the Pilbara region of the northwest. So looking at gas now, the gas market is expected to rise, with futures pointing about $3 per gigajoule increase in the wholesale market gradually over the next 2 years. Longer dated contracts also point at higher prices, whilst the short-term trading market demonstrates some really competitive priced gas and opportunities for significant savings for business customers currently. As winter gets colder and demand for gas increases for heating requirements, we expect gas prices to rise domestically, but overall we anticipate a period of consolidation for domestic gas market following the recent plunge in demand, and that's internationally as well. So let's have a look at the certificate markets now. The LGC market has once again been volatile, with the LGCs rising by about $4 per certificate to $38.35. VEECs dipped below the $30 per certificate level. That was due to increased supply. As we have talked about in the past, there was an expectation that there'd be an increase in the 2021 target for Victorian energy upgrades, which could lead to increase in VEEC demand and therefore higher prices. But the Victorian government recently announced that amid the coronavirus crisis, it will keep the target unchanged. This has changed the balance of demand and supply in the market, leading to lower prices for VEECs. Eskies in New South Wales have been stable and currently trading at $25.50 per certificate, and Eskies target is now expected to remain unchanged as well. So in the news this week, Australia's lucrative exports of natural gas are being hit by a global supply glut, and the coronavirus crisis destroying demand, with dozens of cargoes either anchored offshore or idling at sea as Asian buyers delay deliveries. Australian LNG exports fell by 7 cargoes in May as Asian buyers delayed deliveries and sought to minimise contract purchases. Unlike the world's major oil producers, many LNG exporters are yet to curtail output, meaning the fallout could be longer and more severe than the oil price crash. The IEA said natural gas markets were experiencing the largest recorded drop in demand of 4% by the end of 2020, which was likely to lead to lower prices. By 2021, the IEA expects gas orders to recover in mature markets and expand in emerging markets. That's the wrap this week. Thanks very much for your attention.